Hey, it's Rav. You're watching The Everyday Investor, the hottest real estate investment show in the world. That's right. I said it. I don't care who knows it. We've got a phenomenal show for you today. Not only is my guest host lawyer extraordinaire Anthony Maniaci, but we've got a few everyday people in here that are, very sophisticated and in my eyes making great returns investing in real estate. Our topic today is simply just investing in rental properties. Get your pen out, your paper, your calculator. You don't want to miss this show. We always ask the 4 questions whenever we're presented with any kind of investment opportunity, whether it's real estate, whether it's just a business. The first question you always want to ask is, what is the return on my investment? Very important. When I put $1 out, I get the dollar back, and how much more do I get back with that? What's the ROI? Secondly, when do I get that return on investment? Thirdly, what is the risk, the worst case scenario? Whenever we're being presented with this opportunity, you look them right in the eyes and you say, what could go wrong? Again, my good friend Anthony Maniaci is on the show. Anthony, it's great to have you here.
Great to be back.
Yes, I don't bring you on this show because you handle my financial affairs. I bring you not on this show because you're so handsome. I bring you on the show because you're so well versed. I mean, you're a real estate lawyer, corporate law, all that kind of good stuff. And I just really appreciate you taking the time when I asked you to come down, and it's just wonderful to have you here. So thanks for being here.
Always happy to be here.
What's happening in the world of real estate investing? Here we are, 2016. Our friends in BC have been hit with a big tax there. Talk about that, how that works, and how does that affect us here in Ontario?
Well, the actual effects of this foreign investor tax that has been implemented in BC won't be felt for a little bit of time, but we are slowly starting to see an increase of foreign investors coming over this way to Ontario. As a result, we're going to have to be very conscious when it comes to valuations of the properties to ensure that we don't get caught up in the same sort of bubble type atmosphere that did exist.
So is that what happened? Like, why did the government do that? I mean, if somebody would ask me, hey, do you see Vancouver falling? Do you see Toronto falling? It's always based on interest rates, and nobody has a crystal ball to be able to see what they were. But I never imagined that, the government would step in now and kind of create this. Why did they do that?
Well, it's a bunch of things. But if you think about these people coming in from overseas, they tend to be buying in American dollars. So right off the bat, they're getting somewhere around a 25% discount.
Yeah.
So as a result, they don't mind paying more than what the value is because they can cover that difference. So right off of the bat, these people are coming in at a strong advantage to the people who are within the various different municipalities looking to buy because they have that purchasing power.
Okay.
So what's happened is these people have come in, they're buying. BC has an issue with this shadow flipping thing that's going on where people are artificially inflating the price by flipping the property, and then getting a foreign investor to basically buy it at that hyperinflated price. As a result, there's all kinds of problems that have ensued. People have taken advantage of mortgage loopholes in order to get it. And there were articles in the paper this week about how foreign investors are taking advantage of different loopholes within the mortgage and lending guidelines of the big banks especially. And as a result, they're at another advantage within getting that mortgage that the people within the citizens of this country don't necessarily have.
I see. As well, people are just walking away. So there's a big mess over there. I mean, if somebody buys a property for $500,000, it's a 15% tax, correct?
Well, only foreign investors.
Foreign investors. Suppose they bought it.
Right.
There was no grandfathering in.
Right.
So let's say it was time to close.
Yeah, people did walk away from the deal.
$75,000.
And you see the plummeting of the price as a result because now all of a sudden there isn't that artificial market buoying it up.
Yeah. So if my deposit, let's say it was $40,000 on $500,000 property, or even $50,000, 10%. But now you've added $75,000.
Right.
A lot of people are walking.
Right. And so what's happening is they're moving up to Ontario or whatever the case may be where this issue doesn't exist. And so what's going to happen, and what we have to be very cognizant of is how that affects the valuations here. Because there's an old adage in real estate that your house or your apartment is only worth what somebody is willing to pay for it. So inherent in that conversation is that it's sort of artificial.
Yeah.
So if you have people coming in willing to pay at a premium because they're buying with stronger dollars, you've got an artificial increase in the purchase price.
Great point. Yeah.
And so you have to really, really, really be vigilant. I mean, we've got, again, soaring hydro rates in this province as well.
Yeah.
That's been well documented. And even though Premier Wynne has decided to reduce it by 8%, unfortunately, there are shadow taxes there that kind of offset. And I don't know about you, but I've seen my utilities go up by 34%. So bringing it down 8% really is not going to help me that much. It's about $130
Turn off
a
the
year.
lights, kids.
Yeah, right.
Yes.
And so it's almost disingenuous in a sense. So these are things that we have to be very, very cognizant of.
Yeah.
We have to be aware to ensure that, you know, when we're investing in a property, especially like we're going to be talking about today, that these things don't eat into our bottom line. Because again, you need the exit strategy. That was number 2 point on your intro.
Yeah.
How do I get my money out?
Yeah.
There's 2 ways. You can do it by way of getting a mortgage and refinancing the property, taking the equity elsewhere. But if the property valuations go down because there's an artificial bubble that bursts, then what?
Yeah.
Then you're left either holding the bag, or you can't sell it, or you can't get out.
You are such a smart man. I'm glad you're on the show. You're watching The Everyday Investor. When we come back, we're going to talk to AJ and see how he's making some great money on his dollar. You don't want to go anywhere. The Everyday Investor will continue in just a moment. Thanks for watching, everyone. Whenever you're considering to invest in real estate, always ask the 4 questions to start. 1, what's the return on investment? 2, when do I get that return along with the money I put in? 3, what is the minimum cash amount needed? And number 4, what is the risk, the worst case scenario? Hey, it's Rav. Welcome back to The Everyday Investor. Today we're talking about how to make money investing in rental properties. I have my guest host here, lawyer extraordinaire Anthony Maniaci. I've got a good friend here, the Everyday Investor, but the distinguished gentleman, AJ Callon's here, and he's going to teach us how he's doubling his money every 3 years or so in investing in real estate. Before we talk to him, we're going to go to our mortgage specialist, Carmen Caponero. What's happening, Carmen?
Thanks, Rav. Well, today I'd like to talk to you about commercial financing. And I wanted everyone to know and understand that commercial financing is a lot easier to obtain than you think. Today in this market, with residential financing being so difficult to obtain, it may almost be a better direction to look for financing on a commercial property, which would be 5 units plus. When you go for financing on a commercial property, take note that the income qualifications are based on the property's ability to service the mortgage, not you personally. Where in a residential mortgage, they base the whole process on you personally and your income and your availability to service that debt. Interest rates are extremely competitive, so if you want and you're looking to buy a residential property that you're contemplating and you're having a challenge with the banks, seriously think about just going up a couple more units and you can get a commercial mortgage a lot easier. Hope that helps. Back to you guys.
Thanks, Connor. Appreciate that. Always great to hear your voice and more importantly, your wisdom. Anthony, AJ, thanks for being here.
Great to be here, Raf.
Yeah, your thoughts. I mean, she's basically saying that as real estate investors, another option as the banks get stingier and stingier with residential properties is that it's actually easier to qualify with commercial mortgages because they actually look at the business aspect of it as opposed to whether I returned my video on time or not. Mm-hmm. Do we still return videos 2016? I don't think so, but you know what I mean. So your thoughts on that?
Well, it's interesting. We've seen so many changes on the residential side when it comes to mortgages over the last 3 or 4 years, whether it be through CMHC imposed changes, the governmental changes, etc. They've kind of left the commercial side alone. And so I happen to agree. I think that we are seeing that if you can get a property zoned to a place where you are at that range of 5 or greater, they're not looking at the same criteria. They're not making it as difficult because, again, they're looking at it as a commercial venture, and the commercial venture just has to be able to keep itself in the black on its own. Mm-hmm. You need to be wary out there that just because of that, sometimes they will not just go on the property loan. I mean, you yourself will have to qualify. You may have to guarantee the loan, those sorts of things, but that's a deal-by-deal kind of thing.
Sure.
And so I do happen to agree. I do see it. And again, it's predominantly because there's been so much focus on the residential side because of what we were talking about earlier with respect to such an influx of foreign money, the increase in the buying power of people here and so forth, that our market has shut up.
So AJ, you're been investing for a while now. You and your wonderful wife. She's doing well.
She's doing
Manpreet,
awesome.
and
Yes.
we have what? 2 munchkins? 3?
We have 2 right now.
2 right now. Okay, great. So are you playing a little bit in the commercial space? Are you
Yes.
into the multiplexes? and-
Absolutely. Actually, the property today is actually a commercial property. It's a 6-unit building.
Oh, it's a 6-unit building.
Yes.
And so going through this experience, did you find that it was easier to get the mortgage for that than just, buying a duplex, for
Yeah,
instance?
I would say so. In this one, this specific case, we did have multiple options. We actually ended up getting a residential mortgage. But yes, a commercial mortgage would have been a little bit easier.
And why did you go the residential route?
Because the rates were a little bit lower on the residential.
Okay, great. It's all about the dollar at the end of the day, right?
Absolutely.
I mean, generally speaking, sometimes if it's we don't mind borrowing money if it's a little bit easier, even if we have to pay a little bit of a higher price. But if it's apples and apples, then obviously we want to pay interest as low as possible. So we're going to look at a property right now. Thanks for being on the show. I appreciate it. It's always great when I can have you here. You said it's a six-plex. So where did we purchase this?
It's actually in St. Catharines.
In St. Catharines? Okay. But you live in Mississauga.
That's right, yeah.
So it's possible to invest in a place that's not our own backyard.
Yeah, I like to invest where the returns are the best and
Yeah.
where it makes financial sense.
Okay, great. So you bought a property, it's a six-plex, and you made an ROI of what?
It's 30%.
30%, annualized.
That's right.
Okay, so you're going to teach me how you did that? This marker's terrible. Are you going to walk me through how you did that, okay?
Sure.
There we go, blue. Okay, so this is your ROI on an annualized basis. So take me through some numbers here. What was the purchase price?
So we got this for $348,000.
So the purchase,
So $348,000.
okay, $348,000 in St. Catharines.
That's right.
That's a pretty good number, Anthony. $350,000 for a six-plex.
There's value there.
Yes.
No question.
So now I understand. I don't think you're going to find that in Mississauga.
No, I don't think so. I think you may get a basement for that.
Yes. Okay, so $348,000 was the purchase price. And how much did you put down?
So we had to put 25% down on this one. So
Okay.
it's $87,000 plus $7,000 closing costs. So
Okay,
we'll
so you put 25% down
That's right.
on this, which equals what?
It's $87,000.
87,000, and then plus closing, you said?
Yeah, $7,000 closing costs.
7,000 to close. And did you do any work to this at all?
This is a turnkey. So
Turnkey.
there
So
is
explain
no-
to the viewers at home what that means. What's a turnkey?
Turnkey means that on the first day, there's cash flow coming in. There's
Yeah.
people, there's tenants living inside the property,
You don't have
and
to
no
do much to it.
renovation is required.
Okay, great. Maybe a little lipstick here and there,
Sure,
but not
yeah.
too much. Okay, so altogether, you're in this property for what? 94,000.
That's right.
So you are in this property for $94,000. All right. And so how are we making money on this property? It increases in value, obviously. And what do you use? I'm going to put an arrow up to call that, let's say, just inflation. Passively, you're not doing anything. What percent do you use for that?
I like staying conservative, so I use 3%.
3%.
Yes.
That's very conservative today, because generally,
Yeah.
realistically in that area, what would it be? 6, 7, 5, what?
It's been a lot more the last few years, but running average is about 5 to 6%.
And you're using 3%.
That's right.
I like your style. All right, so 3% increase on that property value is what? 7,500 or so? What would you put?
3% annual passive appreciation is $10,000.
$10,000.
Yes.
What am I talking about? What's wrong with me? I'm Indian like you. I should be good with the numbers, no?
You should be, right?
Yes, I should be. Okay, so of course, 350 times around 3-ish, 10K. So that's on the up, and then somebody's paying your mortgage down for you.
Yes.
Not somebody, 6 somebodies, 6 people. You're getting 6 rents for how many furnaces are in there?
It's actually interesting enough. There's a commercial unit in there and
Yeah.
5 residential. So there's 2 different furnaces.
2 different furnaces. That's pretty good.
Yeah.
6 rents for 2 furnaces. I like it. Okay, so when they're paying down, you have a mortgage here. They're paying it down. It's like money that's going under the mattress.
Sure.
How much is that?
$7,000.
$7,000. So 7K, and then there's a little bit of cash flow, on there, or maybe lots. I don't know.
I think it's decent amount of cash flow.
What's your expenses? So you pay mortgage,
Yep.
taxes. Who pays utilities?
So some utilities we pay, and some utilities the tenants pay.
Okay,
so
so
we pay for the water and for the gas.
You pay for water and gas, okay? Not hydro.
Not the hydros.
Lucky him, Anthony, since it's been going up lately.
Up.
Up.
Yeah.
Okay, so when we're done with all of our expenses and we get that rent, that difference we call cash flow.
Right.
Take your wife on a date with that, or put it back in the property, or bank it, or whatever you do. Okay, so how much is that?
It's $11,000 for the first year.
$11,000.
Yes,
So that's like 900 and change a month you're getting.
that's right.
That's wonderful.
Yeah.
For a purchase price of almost $350.
Phenomenal.
That's fantastic. So $11,000? That's what you said?
Yes.
So what's my math here? What do we got? 28? Is that right?
Yeah,
28,000?
that's right.
Okay, so you are making 28K just in the first year on this property. So I want everyone at home to understand that AJ is making $28,000. Now, a lot of it's not liquid. What I mean by that is only the cash flow, the 11K, is coming back to him. It's going up in value every single year. That's what real estate does. It goes up and down, upwards. He's got somebody else paying his mortgage. This number, 7K, is only going to get bigger and bigger as he's paying less interest to the bank and more goes towards the principal. So in his first year, he's making $28,000. So if I take 28, this is how we figure out our return on investment. If I take $28,000 and divide it by 94, is that right? Is that how I do that?
Yes.
So I take that and I just divide the two. You say it's what?
It's about 30%.
30%? I believe you, but I got to make sure here. You don't mind. 28,000. You like my calculator? Divided by
Nice and big.
94,000 equals 29.78%. Fantastic. So this is how we get this number here. 28K divided by 94K gives you 30% annualized, basically doubling your money, in less than 3 years, because numbers change, so on and so forth. And then, so what's next steps? Do we just kind of hold this? If it goes astronomically, because we only use 3% for the increase, would you pull money out if the numbers made sense and then do it again?
Yeah, so this is something that's what I call the purpose built.
Yeah.
It's a strong building. So what I would do in this case is keep this as long as possible.
Yeah.
Refinance in the future and buy more properties.
And buy more properties. Okay.
Yes.
Purpose built.
Yes.
Purpose built. Explain again. What does it mean?
Purpose built is when the original structure was built up, it was purposely built for 6 units. It's not a single family home that's converted.
Yeah.
It's simply built for 6 separate units.
Okay, great. Now, somebody's watching at home and they said, Rav, I thought you said this was, this show's the everyday investor, but AJ's like Donald Trump here. He's bought a Six-plex. But put them at ease. I mean, is this just as easy as somebody going downtown Toronto and buying a condo? Like, is it, in terms of the work and what we have to do, obviously we've got to find 6 tenants if it wasn't tenanted,
Yeah.
but put that aside. Numbers are just numbers. It's not a big deal, or what are your thoughts there?
I would say the concept is the same. Numbers are numbers. Numbers work. It's a great investment. The numbers don't work. It's not a great investment.
Yeah.
The difference I would say is in your team. I definitely have a great team around me. If it's a mortgage
What does that
broker,
mean? A great team.
Great
like,
team.
Like Anthony's part of Rav's team.
Absolutely.
He's
So
a great
Anthony
lawyer.
is a great lawyer. So you definitely need a great lawyer on your team. You
Okay.
need a great mortgage broker. You need a good realtor on your team as well.
Okay, that's great. So a realtor, do you use one for all of Ontario, or did you, for this particular property, you used somebody who knew the area, used somebody in St. Catharines?
Yeah, I've seen people use one realtor for the entire country, but I would suggest use somebody who is
An area specialist.
Area specialist, exactly.
Okay. I even go a step further at the risk of offending a lot of my friends and colleagues. I use people who are in the investment game as well. So if that
Exactly.
particular realtor didn't have investment properties, just for me and my comfort, doesn't mean that we shouldn't be doing it. Everyone has to start somewhere. But I like for my my accountant, for my lawyer, for my realtor, for to have investment properties as well. Because, for example, Anthony knows what's going on. Things change, so often. Are you the same way, or?
That's very important. Absolutely.
Okay, great. Well, listen, AJ, congratulations. It's always inspiring when I can have you on the show. Give my love to your wife. What's next? Are you planning any other properties here in the near future?
Yeah, so this is what I do on a full-time basis now.
Oh, okay.
Yeah, so always something on the go. As Anthony stated before, the market has gone bananas, but it's a good thing as well. A good thing as well, because all the current properties are also appreciating at the same rate.
Okay. Well, your info's been on the TV here. If somebody wants to get a hold of you, they can.
Sure, absolutely.
Thanks
We'd
for
love
being
to.
here. Appreciate it.
Thank you so much, Rav.
We've been talking to AJ. You've been watching The Everyday Investor. Don't go anywhere. We have lots more fun. More people coming on the show teaching us how they're making money investing in rental properties. Thanks for watching, everyone. Did you know that investing in real estate is never risk-free? It's a never risk-free endeavor. Always ensure to seek the proper professional advice before you sign on the dotted line. Hey, it's Rob. Welcome back to The Everyday Investor. It's been a great show thus far. Anthony Maniaci, guest hosting for me, with me. We've talked to AJ. We learned how he made and is making over 30% annualized returns buying a six-plex in St. Catharines. I'm so excited. I'm stumbling all over the place. Lorna is on the show with us today. Lorna, it's great to have you.
Thank you.
Yes.
Nice to be here.
Thanks for being here. You look lovely. You look like a little bit of a rock star. You're an investor. What else? Are you mom, wife? What are you?
Mom, wife, a little bit of everything, and I still work full time as well. So.
Is that right?
Yes.
Just the everyday person, just making some money in some real estate.
Definitely.
That's great. And so, are you the one that predominantly kind of pushes this world? Does your husband help out as well, or is it mostly you?
My husband is behind me, pushing me, I think, more than anything. This was kind of my dream to start doing some real estate.
Yeah.
But he's right behind me, pushing me along.
That's wonderful. You know, Anthony, you see many people, you see many couples. Every time I see you, Sinead is with me. She's the smarts and keeps me out of trouble. But how important is it that, you know, in your professional career, when you see people and yet husband and wife are not on the same page?
It makes things very difficult because it makes all of the decision making much more onerous, obviously, especially when you're talking about the family money, when you're dealing with how the family is going to invest its funds and moving forward. So much like we've been talking about and have talked about on the show many times about the strength of your team, you know, it's funny, we never mention the spouse. We always talk about the accountant.
That's a great point.
The real estate agent, the lawyer, etc., but we never talk about the spouse. And I think without that backbone,
yeah,
you really have nothing. That's not to say that if you're single, you can't do it on your own. But I'll tell you, having somebody, as you say, pushing you along, giving you that support, backing you up, being that voice, that ear to bounce ideas off of and make sure that you're always working in the right direction, it's absolutely critical.
Mm-hmm. That's great, Lorna, that you could do that, and he's supportive, and you work full time. So it's possible to invest in real estate, because AJ came on the show, and you know, I think he was working full time when he started with the first one or two, and then eventually there was enough cash flow there that, you know, he didn't need to do that. Is this your first property, second property, third that we're going to look at today?
The one we're looking at today is my first property that we purchased.
Okay.
We have purchased 2 more since then.
Wow. You moved quickly.
But it was a lot of fun.
It was a lot of fun.
Yeah.
So this was your very first property, and you live where? In the GTA? You live in?
I live in Mississauga.
You live in
Yeah.
Mississauga, and we're going to be looking at what?
We're looking at a condo that we purchased.
Yeah.
In Mississauga.
In Mississauga?
Yeah, down close to Clark's and Go.
Okay.
So it was
Nice area. That's near the water, right? Ish?
Yeah, down towards Lakeshore. Yeah.
Okay. And that was the first property. And so then when you said you've had 2 more since
Yes.
then, so did you refinance the first property? Have you left it where as is and the equity's just building, or?
We've left it as is for now. It's only a little over a year old.
So you bought 3 investment properties in a year?
Yeah.
Wow. Yeah. That's exciting. And I think it's very important for the viewers at home to understand that this is, you know, it's just kind of everyday life. It's a little bit, we're a little bit afraid, you know, for the first property getting in, but after we get in, we realize this is really not a big deal. It's actually boring Do you find that in a sense, like in terms of the management of this particular condominium? Is there a lot of hands-on work, or is it kind of just, you know, builds itself?
I think that's what I like about the condos is it's very passive.
Yeah.
You really put a tenant in there. You show up, you know, at Christmas time with a gift or once in a while and just say hi and thanks for being a great tenant. And, you know, the 1-year anniversary, make sure you give them a nice gift, and that's about it.
So we don't really have to pay attention to all these, you know, horror stories that we read in the media of tenancy and so on and so forth. Now, if we don't do it right, I'm sure you've done your due diligence when we tenant out, you know, our product. But if you do your due diligence, then it's great. And I think a lot of times, Anthony, when we hear these horror stories of tenancy, it's because the vendor, the owner, you know, maybe they were sentimental, maybe they didn't do their due diligence, maybe they needed to rent it out quickly. I mean, do you find that?
My experience has been predominantly that's the case, and we've talked about this too many times over the years, that due diligence is such an important piece, and whether it's buying a property or vetting your tenants, you really, really need to do that background search. You need to dig into who those references that they provided you, who are they?
Yeah.
What is their experience? You don't want somebody who really is just going to be there to say they're a really nice person and move on. I mean, you really got to do your background homework. A little bit of work up front, as we always talk about, saves you a heck of a lot of work on the back end.
Yeah. Okay, well, Laura, let's, congratulations. First of all, that's inspiring. I love to see people buy real estate, you know, just a full-time job, you're a wife, you're a mom, and you know, making some money in real estate. So let's take a look at this. This is a condo in Mississauga. You bought it about a year ago. What was the purchase price on that?
Purchase price was $264,000.
$264,000. And how much did you put down on that?
The down payment was $53,000.
$53,000. What percent is that? Do you have that there?
That there was 20%.
20%. So that's typical, right? That's kind of what the banks still want us to do, Anthony.
Well, we have no, on an investment property, we have no choice.
Yes.
There will be no CMHC Genworth type insurance, and as a result, you have to put down a minimum of 20%, and then the bank takes over from there as to whether or not it fits the guidelines. If you need a little bit more, like AJ maybe, who needed that extra 5%.
Sure. Okay, so we're in for $53,000. Okay, great. And anything else? I mean, it's a condo, but I'll still ask, did you do any renovations to this at all? Or
No, it was 5 years old, so it was pretty much turnkey.
Okay.
Just a $4,000 closing, and that was it.
Okay, so $4,000 to close. All right, so we are in for, I said 53, we're actually in for $57,000. Okay, that's our number. And so we make money 3 ways: the inflation, the cash flow, and somebody paying down our mortgage, correct? So how much did this, I mean, this isn't a great area actually.
Yeah.
So I'm curious to know what percent did you use on this?
For the annual appreciation?
Yeah, the passive appreciation, just going up naturally.
We used 5%. And the
5%?
reason I used 5% was just because the property itself we got for quite a bit below what they were selling. So we use 5% for it.
That's very, no, in Mississauga down by the water, that's very conservative.
Yeah.
So if we use 5%, what number is that?
$13,200.
13,200 is how much it went up if we use 5%. And then after all your expenses, this is one tenant,
One
right,
tenant.
obviously. And so how much is the cash flow?
$2,900
$2,900. Oh, a year.
a year.
Oh, okay.
Yeah.
So about $240 something a month.
Yeah.
Okay. So $2,900 is the cash flow, which makes sense. It's about $250 a month, which is a nice number to look for in a condo. You know,
Yeah.
if we can get $200 to $300 in there, and then he or she is paying down your mortgage. How much is that being paid down a year?
$5,200 per year.
$5,200. Okay. So this all equals what? Do you have that there, or do you want me to use my
Use your trusty
my
calculator.
trusty calculator? Okay. So what do we have on the up? You're making 13,200 plus cash flow 2,900 plus somebody's paying down our mortgage 5,200. Correct? I got 21,300. So 21,300. Of course, we want to divide that into what we're in for. So I take 21,300 and divide that by, what did you in for? 57? 57,000. Do this at home with me, guys. And then we move that decimal place over twice. And I didn't ask you this beforehand, but what was your ROI?
37%.
Exactly. Just testing you. 37%. I mean, that's, Anthony.
It's what the banks give you, isn't it?
Yeah, exactly.
Fantastic.
Maybe if we move the decimal, maybe,
Maybe.
in the good old days, 3.7%.
Maybe.
In the good old days,
Yeah.
you don't see that. So we're putting, Lorna, you're putting $1 out. You're getting the $1 back plus 37 cents.
Yep.
I mean, that's fantastic. Congratulations. So what's, you did 3 in a year. So now what? Are we taking a break for a little bit, or?
No, hubby's pushing towards multiplexes. So,
Hubby.
Yeah.
Easy for him to say, eh?
Easy,
Yeah.
easy, yeah. No, he's pushing for multiplexes, so maybe I'll rely on AJ and Kyle to help me with that when that comes along. But,
Yeah,
yeah.
that's great. And you had 2 other properties since this one, and where are they located?
So one is in Toronto, and the other one's in Oakville. It's a new build.
A new build. So you did pre-construction.
Yeah.
You had to put down what % on that? Because builders are a little bit different.
20%.
So you put 20%, and it's going to be built, what, 3-4 years?
No, it'll be ready December 2017.
December,
Year and a half.
a year and a half. Okay, that's quite quick.
Yeah.
Isn't it? No, I guess I'm thinking it's not a condo. It's a townhouse, or what is it?
No, it's a condo.
Depends on the stage of development
Yeah,
at the time.
Okay.
it's only a
Depends
three.
when you came into it.
Yeah, it's a 3-rise condo.
okay.
So
That's right.
Yeah.
Low rise.
My favorite.
So,
Yeah.
so
I love the low rise.
Anthony, since we're on that topic, what are your thoughts with the pre-cons? What do we need to look for? Obviously, one of the biggest things is just because that pretty salesperson is in the office telling us, yeah, it's already been vetted, our lawyers have looked at it. Prudence says that we have our own lawyer
Naturally.
look at that, but a lot of people don't.
No, they don't. You're right.
Can I say even most? I mean, it's how
I think
about-
people have gotten educated.
They have
I
gotten
found
educated.
that it's gotten a lot better over the last 5 to 7 years for sure.
Yeah.
I would say now we're predominantly at maybe 70 to 75% of the purchasers who will come to get it vetted. It's just because what happens on a new build, and one thing you have to be very cognizant of is just because you have a purchase price, there's other things that get tacked on to that. There's
course.
adjustments on that purchase price. And the most notable being the development charges, the land levies for things like educational charges and so forth that can get quite high.
You're
if
going to
you
put a
don't cap
shrub.
them.
You're going to put a shrub in my front yard as well to make it the curb appeal nice. So says the builder. Who's paying for that? I mean, I've
Right,
even seen
right.
things like that, right?
Yeah.
And so when I can give something like that to my lawyer, he looks at it. You can cap it for me. You can send it back.
And you get your cost certainty so that there's no surprises. I find that the clients who are the ones that don't do their vetting ahead of time are the ones who end up with a surprise $20,000 that they're scrambling at the end to try and figure out where it's going to come from.
Yeah. Well, that's great in Oakville.
in Oakville.
In Oakville. And then, sorry, the other one was
Toronto.
in Toronto, and that's a condo.
Yeah.
And it's cash flowing.
Yes.
Wow. So tell me about that really quickly. So you bought it because it's hard to find a cash flowing property in downtown Toronto.
Yeah, and I think.
Did you have to put more than 20% down
Yeah, I put a little bit more than 20%
to make it work?
Yeah.
But
Yeah.
you're banking on the Manhattanization of the city. You gave yourself 5%. It's not 5% downtown Toronto. I mean, it's a lot higher than that. And so
Yeah.
I think is that one of the reasons? Or maybe you want to retire there one day, or.
I think we were looking at it more as an investment style, not really retiring in downtown Toronto.
Yeah.
I'm more of a country person, so I'd like
Nice.
a little more land, I think, than that. But
You got you got the Shania Twain kind of going on there. I see
No.
that. But listen, Lorna, it's great to have you on the show. Very inspiring. Anthony, she's doubling her money every 2-point-something years just on this particular one. And
On
yeah,
a passive basis, no less.
absolutely. Thanks for being on the show.
Thank you.
Appreciate it. You're watching The Everyday Investor. We've looked at what AJ's doing, what Lorna's doing. We're not done yet. Kyle's coming on the show. He's going to teach us how he's making money investing in real estate. Don't go anywhere. The Everyday Investor continues in a moment. Did you know that you may still be entitled to the HST rebate when you purchase a new home or condo, even if you're not going to live there? If you fit the criteria, you can apply for the rebate post-closing. Hey, it's the Everyday Investor. My name is Rav Toor. You've been watching a show where we've been talking about investing in real estate rental properties. We've had some great guests on the show. My guest host here with me is Anthony Maniaci, lawyer extraordinaire, and now we're going to be talking to Kyle Ford. Kyle, thanks for being on the show here.
Thanks for having me, Rav.
Appreciate you taking time out of your schedule. Very curious when I heard that in the first year with a property, you made 72%. So basically, you put $1 out, got the dollar back, plus kind of 72 cents, if you will. Now, obviously, it's not liquid. There's the cash flow component, but you put some sweat into there, I guess. You did some work. Our other two guests, they're both turnkey properties. Remind us, Anthony, again what turnkey means.
Turnkey is you walk in and you're already tenanted up. You don't really need to put much lipstick, maybe a coat of paint, that's about it.
Yeah.
You know what you think?
And so obviously when you put some work into it, you're going to make some high returns. Now there's nothing wrong with 30%, 37%. It's quite beautiful actually, as we saw AJ and Lorna do. But when you put in a little bit of work, you can make 72%. This is what's been appraised with the property. So let's just jump right in, Kyle. You live where?
Kitchener.
You live in Kitchener, and is this particular property in Kitchener?
Yes, it is.
And so, is it because it's in Kitchener you bought it, or the numbers just made sense for you?
The numbers made sense, and it is nice to be close to home.
Of course. I mean, that's always ideal. Anthony, if somebody lived in Kapuskasing, Ontario, and the numbers didn't work, we probably wouldn't suggest investing there. But as we saw with AJ lives in Mississauga, and he had a property in St. Catharines, and he was making, doubling his money every 3 years or so. So as long
It's
as
a function of understanding the market. At the end of the day, again, due diligence plays in, and you really got to know. So if you start in your own backyard, at least you have a leg up that you probably have a pretty good feel for the neighborhood and what you're doing. And as you branch out and as you learn and get experience, you understand how to do that due diligence. And once you get to the experience of a guy like AJ, you're able to branch out.
Yeah, no, absolutely. So, Kyle, the property we're going to look at, is this your first property, your only property? Do you work full-time? Are you a full-time investor?
This was the fourth property
Okay.
that we acquired.
Look at you.
And
You say we.
I work with my mom and my sister and her husband.
Love
so
that.
Good. A family team.
I love that. But are you the one that kind of spearheads,
Yeah,
looks
definitely.
for the deals, that kind of stuff?
Yeah, absolutely.
Okay, great. So this property is what? What are we looking at here?
It's a purpose-built triplex.
Purpose-built. What does that mean?
It was built to be a triplex.
Okay, so we didn't take a single and convert it to a duplex, or a duplex to a triplex. This is what it was built for.
Yes.
Okay, so we bought a triplex. How old is that?
Early 60s.
Okay. Nice. And what was the purchase price on this?
$485.
$485. So our purchase price on this bad boy, $485,000. All right. And so when you bought that, was that market value at the time? Was it below market? How did you acquire this?
I bought the property privately, and I believe it was a little bit under market value.
Okay. That's
$15,000 to $20,000 under market value.
Of course, and that's nothing wrong with that. I'm not going to ever take advantage, Anthony, of grandma, but we can still find some great deals where we can buy them for 5-10% below market value if we really look. So this was a private deal, so it wasn't on the MLS. Usually when it's on the MLS, we've got to pay realtors and so on and so forth. And so if we can get a private deal, usually we can get it at a bit of a discount. So what was the down payment on this? Did you put 20% down? Or
20% down, so 97.5.
So the down payment, 20%, 97,500.
Yep.
Okay, what else on that?
And $6,000 in closing costs.
Plus 6,000 in closing costs. All right, is that it?
Yep.
Do we have some rentals to this, or are we going to put that number in later?
We do have rentals, which is a separate cost of $45,000.
Plus 45. So do you mind if I add this
Yep,
here?
sure.
Get our plus 45,000 for some work. All right. So you are in for what?
Total investment was $148,500.
Are you sure? I got my calculator here, Kyle.
You can double check it for me,
I
Ralph.
believe you. Okay. So how much?
$148,500.
$148,500. So you're in for. All right. So you're in for almost $150,000. All right. Now I see a little bit of why this is a bit of, because not everybody just has $150,000, in their pocket. But if we can have some partners, and I always say if it's friends or family, it really means that we really believe in the deal. Start there. And if that doesn't work out, then we branch out to some other people that want to partner with us. But you put in $150,000 basically to buy this triplex. So tell me what we did to make our return, because our ROI, I already gave it away, in 1 year is 72%, correct?
Yep.
So teach me how we do that.
In terms of the renovations, we fully gutted one unit.
Okay.
New kitchen, new bathroom, new flooring, trim, hardware, all that type of stuff. Cleaned up the hallway, cleaned up the yard, cleaned up
Yeah.
the common areas.
Okay.
The one unit was in pretty good condition. And then the other unit was mid condition, so it wasn't a full gut, but we did quite a bit of work to that one as well.
So you increase the value. It's no longer worth $485,000.
Yeah.
What's the new value on this?
The new value is 600.
$600,000.
Yeah.
Okay. So you want me to rate 600, or do you want me to? You increased it by $115,000. Is that correct?
Yeah.
Okay. So the up was $115,000. That's amazing. So you put in $45,000, and you made $115,000 on that. Pretty good, Anthony?
I'll take it.
I'll take it. I mean, I wish I knew how to do it. I mean, you did this yourself. You weren't like the general contractor and watched everybody do this. You actually did this work.
No, I hired the general contractor.
Oh, you did?
I did, yes.
And that's still what, and all in, you were for $45,000.
45.
While you paid people out.
Yep.
Okay. You need to teach me a little bit. Okay, so you made $115,000 on the up. Okay, what else? Well, how else did you make money on this property?
Oh, sorry. On the appreciation, $70,000.
$70,000. Okay, so what am I missing here? So on the you're saying altogether.
Altogether, 115, but on
But
just
we
on
want
the,
to minus the 45.
Yeah, so 70,000.
So you made $70,000.
Yeah.
Great, thank you. So $70,000 there.
It's an incredible
Okay.
return. It's almost double.
Yeah, it's fantastic. And then what else? Somebody's paying your mortgage.
Yep.
Okay, so-
91.5.
91 in 1 year.
Yep. No,
No, 9,500.
$9,150.
What I was going to say.
One less zero.
Okay, here we go. Nice. And then there's some cash flow here.
Yep. 42.6.
4,000.
Yep. 206.
260.
2.6. Yep.
That seems a little bit low for a triplex. No, because it seems that's about $300 a month for all three.
Yep. I'm factoring in for repair and maintenance,
You're a good
property
man.
management,
Vacancy,
all
all
those
that-
things,
all
being
that
very
kind of stuff.
conservative.
Contingency numbers. I love it.
Yes.
Yeah, that's
We love
fantastic.
that. Okay,
Yeah,
great.
yeah,
Thank
yeah.
you. Okay, what else? Is that it?
And then the passive appreciation.
The passive. Just naturally, it goes up passively. So here's the other. This was the forced appreciation. Forced appreciation. This is passive appreciation. And so what percent did you use on this, on the 485,000?
I use 4%.
4%. Okay, great. In that area, is that pretty conservative?
Very conservative. We've seen much better returns on average 6, 7,
Yeah.
but I use 4.
Okay, so what is that? About 20,000?
24,000.
$24,000, okay. Do you have these numbers all added up? No, you want me to do it?
Yep.
You want me to do it?
If you can do it.
Okay, great. So what did you say? So you forced this property to go up $70,000 by putting some work into it,
Yep.
correct? And somebody's paying down your mortgage, $9,150. Yeah?
Yep.
And then we have cash flow of $4,260.
Yep.
And you have all the things in there for vacancy and repairs, maintenance. And then passively, it just went up $24,000. Correct?
Yep.
So I, on that number, have 107,410. So all this equals 107,410. So this is how much you made in your first year. Now I'm assuming you didn't add the 45 when you did your ROI, correct? What number? How did you get the 72%? What'd you do? You took the $107,000 and you divide it by what you're in for?
Yeah.
Okay, so let me just try this for a second. I think it's going to be a little bit higher. This is how we do it at home, guys. You get your calculator out. You put $107,000, which is your profit. You divide it by what he's in for. What do we say? 148.5. Right? And there you go, 72.3%. Wonderful. That's amazing. And so this is, you said you have, this is your fourth property.
Yep.
The other three, what are those?
I have a condo,
Yeah.
a house, and another triplex.
And another triplex.
And then
Was
I-
that other triplex the third one, or
That was the third one.
that was the third one?
Yeah.
So you're starting to realize. I mean, when I first started, I'm 45 now. I first started when I was 16 years old with my mom.
Yep.
We bought a little single in Kingston, Ontario, where I was born and raised. But then I started to realize I want 2 or 3 or 4 or 5 tenants for one furnace, right? Because there's just more bang for the buck. Anthony, I mean, you know, do you see that? You kind of build, right? I mean, very rarely do we see somebody who's never been an investor, invested in real estate, jump right into an apartment building.
It's like what I just said when we were discussing AJ previously. I mean, you build on the experience, 100%. I mean, you go out there, good, bad, or indifferent. When you're able to build on that and you better understand. I mean, a lot of times it's just easier. Start with a condo. Start with a house. You know, make your bones, figure it out a little bit, and as you go, you're able to handle more and more and more as you build on it. So for sure.
No, Kyle, this is very exciting. What I'm most excited about is that $45,000 that was spent in renos. You contracted people out to do it. I mean, I thought that was, you know, maybe just materials, right? So you had to gut the place and so on and so forth. But you're saying you didn't really perspire, and you spent $45,000. And you gave yourself an increase. I mean, the average Canadian salary today is just touching $50,000. You gave yourself 70 grand. You know, you could refinance, pull money out, do it again. What's the next steps for you?
I've done a couple other deals since. I'm closing on my 8th deal in November, which is another triplex.
That's nice. Yeah. And this is not, you don't do this full time. You do other work as well?
Yeah, I work in the insurance industry.
Is that right?
Yeah.
That's fantastic. And so, who was the impetus of all this? Was it mom, dad, brother, brother-in-law, you?
It was definitely me. I got the family on board. But yeah, this is it started off as almost kind of a hobby.
Yeah.
But it's really become my passion, and it seems to pay pretty well as well. So.
You know, I find people, you know, when they start, they kind of take a seminar or belong to some sort of investment network. Are you involved with a network of people that are doing the same thing?
Yeah, absolutely, I am.
What's that?
Keyspire.
Keyspire.
Yeah.
Okay, that's the Michael Saraceni, Scott McGilvery outfit. And would you recommend? I mean, whether it's that one or just you know, having a group of people. Does that help you when you get to see these guys every so often?
100% I do. It definitely gives you the confidence to go forward with the deals. Yeah. And I didn't come up with this strategy. This is something that I was shown. Yeah. And they've definitely supported me in executing these type of deals.
Well, listen, Kyle, very, very inspiring. Thank you for showing this to us, and good luck on your 8th. You say you have 8, or you're going on your 8th?
I'm closing on 8.
You're closing on 8.
Yeah.
Well, good luck with that.
Thanks so much, Rav Toor.
Thanks for being on the show. Anthony, we got some great guests here on the show. Absolutely. You've been watching The Everyday Investor. We've looked at 3 everyday people that are making extraordinary returns. It's been fantastic. We'll come back with Anthony's closing thoughts in just a minute. The Everyday Investor continues in a moment. Thanks for watching. If you have any questions pertaining to this show, or if there's a topic that you would like covered, please visit www.rogerstv.com. Hey, it's Rav. You've been watching The Everyday Investor. It's been a fantastic show, learning how we can make money investing in rental properties. We talked to 3 everyday people. Some have full-time jobs, and they're making some great returns, 30%, 39%, 70% annualized returns. It's great to have my good friend Anthony Maniaci with me on the show. Anthony, I always love when you come on the show. Thanks for being with me. Any kind of closing thoughts? I mean, you've been around the world of real estate forever. Your father has been in the world, the world of real estate, as well as a solicitor. Your brother. I mean, it's a family affair. What is your thoughts, your advice, your guidance, your caution, just as we close the show here to the viewers at home?
You know, we've been doing this show for so long, and there's something we've never really touched on. So I just want to touch on it briefly for all of you out there, and it's something to look at when it comes to your mortgage. We talked about the pay down of the mortgage and how these people are paying your mortgage for you, and as a result, you're getting some income. If you change the frequency of your payment from a monthly payment to a bi-weekly payment, you can actually affect the amortization of your mortgage from a 25-year amortization down by 7.5 years. And what that means is you're paying your mortgage off over 7 years quicker, which means they're paying more of your principal down on a quicker basis. And it really is at no cost to you because you're cashing your monthly rent check at the beginning of the month. So if you pay on the 1st and the 15th, that money's already there.
Yeah.
It's dead until the end of the next month anyway, so why not?
Yeah. No, great point. Great point. People have their information on the screen. They want to ask you some questions. They can get a hold of you.
I'm always around. I'm always around.
Thank
Yeah,
you so much,
absolutely.
my friend.
My pleasure. My pleasure.
For being on the show. I want to thank Anthony Maniaci. Thank you for watching. On behalf of myself, Rav Toor, and Rogers TV, we'll see you next week. Same place, same time. Honey, I love you. I'll be home soon. Ciao, everyone.